Greetings, tech enthusiasts. Welcome to Tech Innovation Park, where we delve into the transformative world of technology and its impact on individuals and businesses of all sizes. Today, we're excited to show you a comprehensive guide to buying Bitcoin through dollar cost averaging. And before we dive into those tech trends, don't forget to hit that like button and subscribe to our channel to stay updated on the latest tech innovations that can empower your business. Remember, knowledge is power. We're here to equip you with the tech insights you need to succeed. Today's video is not financial advice, but a guide to buying Bitcoin through DCA. Ever found yourself puzzled by the maze of buying Bitcoin? Well, you're not alone. The world of cryptocurrencies can be a labyrinth for those just starting their journey. The intricacies of Bitcoin, the pioneer of digital currencies, often pose a daunting set of challenges for beginners. The first hurdle that newcomers face is the notorious volatility of Bitcoin. Its price can fluctuate wildly within a matter of hours, making it a roller coaster ride that often leaves beginners dizzy and confused. This volatility can make buying Bitcoin feel like a risky gamble, making new investors hesitant to dip their toes in the waters of cryptocurrency. The second challenge is timing the market. It's an age-old question in any form of investment. When is the right time to buy? With Bitcoin's price swinging like a pendulum, pinpointing the perfect moment to buy can seem like an impossible task. This often leads to stress and anxiety, as newcomers fear they'll buy at the peak, only for the price to plummet shortly after. The third challenge is determining the amount to invest. How much of one's hard-earned money should they risk in this unpredictable market? Investing too little may feel like a missed opportunity if Bitcoin's price skyrockets. Yet investing too much can lead to significant losses if the market takes a nosedive. These challenges can make the prospect of buying Bitcoin intimidating, even for the most daring among us. But what if there was a way to navigate this maze with a clear strategy, a way to mitigate the risks and alleviate the stress associated with buying Bitcoin? That's where dollar cost averaging, or DCA, comes into play. This strategy involves investing a fixed amount of money in Bitcoin at regular intervals, regardless of its price. This approach can smooth out the volatility, eliminate the need to time the market, and provide a clear guideline on how much to invest. It's a beacon of light in the complex world of Bitcoin, guiding beginners safely through the maze. So, what exactly is this dollar cost averaging? It's a term that sounds a bit complex, but once you understand the concept, it's actually quite straightforward. Dollar cost averaging, or DCA for short, is an investment strategy where you spread out your purchases over a specific period of time. Instead of buying all at once, you buy a little bit at regular intervals. This could be weekly, monthly, or even daily, depending on your preference. Imagine you're at a fruit market. You could buy all the apples you need for the month in one go. But what if the price of apples is unusually high on that day? You'd end up spending more than you need to. Instead, if you buy a few apples every week, you spread out your purchases. Some weeks apples might be expensive, but other weeks they might be cheap. Over time, the cost evens out. This is exactly how DCA works in the world of investing. By spreading out your purchases, you reduce the impact of short-term price volatility. This means you're less likely to buy all your Bitcoin when the price is at its peak, and more likely to buy when the price is lower. DCA is not about trying to time the market or predict price movements. Instead, it's about creating a disciplined investment routine that smoothens out the highs and lows of the market. And here's the beautiful part about DCA. It works no matter your level of investing experience. Whether you're a seasoned investor or a beginner dipping your toes in the world of Bitcoin, DCA can be an effective strategy to mitigate risk and potentially increase your returns over time. But remember, no investment strategy is foolproof. DCA is a tool to manage risk, not eliminate it. So always invest responsibly and only put in what you can afford to lose. So DCA is all about not putting all your eggs in one basket, but instead spreading your investment over time. Now, how do we apply this strategy in buying Bitcoin? The first step in applying dollar cost averaging, or DCA, to your Bitcoin purchase is deciding on the total amount you're willing to invest. This is a crucial step as it lays the foundation for your investment strategy. Take a moment to reflect on your personal financial circumstances. Consider your income, your expenses, your savings, and most importantly, your financial goals. Once you've taken a good look at your finances, decide on an amount that you're comfortable investing in Bitcoin. This could be a small percentage of your savings or a fixed amount each month. However, it's important to stress that you should only invest what you can afford to lose. Bitcoin, like all investments, carries a risk. While the potential rewards are high, so too are the potential losses. So don't risk your rent money, your grocery money, or your life savings. Remember, only invest what you can afford to lose. With the total amount decided, what's the next step? Well, it's time to determine the frequency of your Bitcoin purchases. This is key in understanding how to apply dollar cost averaging, or DCA, to buying Bitcoin. The frequency of your purchases can range from daily to monthly or even quarterly, and each option has its own pros and cons. It's a bit like tuning a radio. You're seeking the perfect frequency that will deliver a clear signal, or in this case, the best possible return on your investment. Let's consider buying Bitcoin on a weekly basis. This approach can help smooth out short-term volatility in the Bitcoin market. By making smaller, regular investments, you are less likely to be caught out by sudden drops in price, as you're not putting all your eggs in one basket at a single point in time. It's a bit like stepping into a chili pool, one toe at a time, rather than diving in headfirst. However, there's a flip side to this coin. The frequent transactions might incur more fees and take a chunk out of your returns. Not to mention, it requires a level of discipline to follow through each week without fail. On the other hand, buying Bitcoin monthly might align better with your pay cycles. This can make it easier to budget for your Bitcoin purchases and provide a sense of routine and consistency. Plus, it can potentially save on transaction fees compared to weekly purchases. But remember, the Bitcoin market can be a roller coaster ride of ups and downs. Buying monthly means fewer opportunities to average out the cost, which could leave you more exposed to short-term price fluctuations. So there's no one-size-fits-all answer here. The key is to choose a frequency that aligns with your financial situation and risk tolerance. Perhaps you're paid fortnightly and decide to invest every 2 weeks. Or maybe you receive a quarterly bonus and decide to invest then. It's all about finding what works best for you in your unique circumstances. So, choose a frequency that aligns with your financial situation and risk tolerance. Now that we have the frequency, what's the final step? The essential question, the last and perhaps the most crucial step in applying dollar cost averaging in buying Bitcoin is consistently purchasing, regardless of the price. Let's delve into this. The crux of the DCA strategy lies in its discipline. This isn't a one-time thing, nor a sporadic endeavor. It's a steady, methodical approach, akin to a marathon, not a sprint. It demands adherence to your predetermined plan, be it weekly, bi-weekly, or monthly. But why is this so important? Well, let's think about it. The market is volatile, prices fluctuate, and emotions can run high. It's all too easy to get swept away in the tidal wave of market sentiment. One day you're up, the next you're down. It can be a roller coaster ride that leaves you dizzy and disoriented. Yet this is where the magic of DCA shines. It's a strategy that helps you navigate the tumultuous sea of market volatility with a steady hand and a calm mind. It encourages you to buy Bitcoin consistently, irrespective of the price highs or lows. You don't stop buying when the price drops, nor do you double down when it rises. This consistency is what smooths out the price volatility over time, giving you a more stable and reliable average cost. It's like adding a touch of predictability to the unpredictable. And this, my friends, is the beauty of dollar cost averaging. Of course, this requires discipline. The temptation to deviate from your plan can be strong, especially during market extremes. Yet it's in these moments that sticking to your strategy becomes even more vital. So there you have it. The final step is consistent buying no matter the market conditions. It's the unwavering commitment to your strategy, the discipline to keep going, and the patience to wait for the results to show. Remember, consistency is key in DCA. Stick to your plan regardless of what the market is doing. Go forth, apply these steps, and let the power of dollar cost averaging work its magic in your Bitcoin buying journey. So, what are the key points to remember about applying DCA in buying BTC? First, we confronted the challenges of buying Bitcoin, acknowledging that the fluctuating market prices can be intimidating, yet there's no need to panic. That's where dollar cost averaging, or DCA, comes into play. DCA is a strategic approach that allows you to invest a fixed amount into Bitcoin at regular intervals, regardless of the price. This method can help you weather the storm of market volatility, spreading the risk over time. The application of DCA in buying Bitcoin involves three fundamental steps. Firstly, deciding on a consistent amount to invest. Secondly, choosing a regular interval for your investments. And thirdly, sticking to your plan regardless of market fluctuations. By following these steps, you can effectively apply DCA in your Bitcoin investment strategy, making the most out of your investments while reducing potential risks. And there you have it, a simple yet effective strategy to navigate the volatile world of Bitcoin. Happy investing!